You grew up believing money was real. Coins, notes, gold bars, solid wealth, right? But what if I told you that the money you trust every day is increasingly just an illusion? And even more shocking, what we once called gold is now being supplanted by debt. Yes, debt is the new gold. It's invisible, intangible, yet it fuels our economy. It's everywhere and also nowhere. So the next time you hear someone say money backed by nothing, pay attention because you might be staring at the tipping point of everything you thought was real. Today, we'll trace how money moved from tangible value to optical illusion, how debt rose to take its place, what caused the shift, what lies ahead, and why you need to understand it before the next wave hits. The answers are buried in history, hidden in plain sight, but once you see them, you'll never look at money the same way again. Let's begin where money first had meaning. In ancient Mesopotamia, 3,000 plus years BC, people used grains, livestock, clay tablets to record obligations. Debt and credit were already present. Then came commodity money, shells, copper, silver, gold, objects with intrinsic value. Gold, in particular, gained the status of real money because it didn't rust. It was scarce, it carried value, even outside being just a medium of exchange. By the 19th century, the gold standard dominated many major economies. Currency units were defined in terms of specific quantities of gold. The system gave a tangible anchor to money. But while gold seemed immutable, the system underlying it was starting to strain. The cause and effect year societies grew, trade exploded, war and debt expanded. Gold as a fixed anchor became a constraint. Money was still real in a sense, but the tension was building. The narrative stability of money backed by gold created trust until it no longer could. As the industrial age deepened and global trade and finance accelerated, a new paradigm emerged. Money stopped being just what you held, it became what you owed, what you promised. The idea that value could be created through credit, through debt, gained ascendancy. According to historical analysis, money systems are shaped by institutions and rules. Coins appeared when states demanded taxes paid in them. By the early 20th century, major economies had huge government borrowing, credit growth, and private banking expansion. Even as the gold standard persisted, it was supplemented by credit instruments, banknotes convertible to gold, bonds, and promises of payment. The cause and effect expansion of credit gives erosion of strict commodity money discipline gives. Creation of a monetary system less anchored to tangible value. After World War II, the Bretton Woods Agreement set a new order. Currencies pegged to the US dollar, which in turn was pegged to gold. But that system rested on promises, not pure gold. The key twist: money was becoming more about trust and obligation than pure metal, and debt was growing to fill the gap. The moment when money fully transformed from physical anchor to promise backed by debt arrives with clarity. On August 10th, 1971, Richard Nixon announced that the US dollar would no longer be convertible to gold, ending the Bretton Woods dollar-gold link that signaled the shift. Money no longer anchored by physical gold. Instead, national currencies floated and credit expanded. From that point on, what backed money was not gold, but the ability of states and banks to issue debt and fulfill obligations. Simultaneously, the theory of money creation was evolving. Money could now be created as debt by banks, the breaking point, a financial system built on growth. Credit expansion, rising leverage without the constraints of gold or fixed anchors. The cause and effect, anchor to gold removed gives credit, multiplies, gives debt, becomes money. The real value is not in gold, but in the ability to borrow and spend. Money became an illusion, a promise to pay, backed by future debt. Once the anchor was gone, the fallout began. Money creation exploded, nations borrowed, banks lent, credit instruments multiplied, derivatives. The modern monetary system became one of debt. The system's architecture, central banks set interest rates, banks lend, money supply expands, debt grows. What were the consequences? First, money lost its certainty of value. With floating currencies and no tangible backing, value became more about trust. Second, debt became omnipresent. Governments, corporations, households were all indebted. Third, crises changed shape. Instead of gold runs, we got credit crunches, liquidity failures, cascading defaults. The system moved from metal to promises, from what you hold to what you owe. The long-term effect, the illusion of money, masked the fact that underlying obligations, debt, were becoming dominant. As one paper noted, consumption funded not by savings, but by finance and borrowing. Money became a system of debt claims, and debt claims became money. The fallout extended globally. Some countries became indebted to others. Sovereign debt became a tool of control. Attempts to anchor money again and why they fell short over decades. Governments and economists attempted to restore stability, return to gold or gold-like anchors, impose stricter regulation, reduce debt, limit money creation, but each time the fix failed because the underlying architecture of debt money was entrenched. Gold-backed currencies were abandoned because they constrained governments' ability to spend and borrow in times of crisis. Credit systems replaced them. Attempts to regulate banking and credit after crises, for example. Post the 2008 reform addressed symptoms, but not the root moneyist debt. The cause-end effect, monetary system goes off anchor, debt grows, reform tries to restore anchor, architecture resists. The fix fails, ceasing adapts. Because once money became an illusion, returning to real money became impossible without massive disruption. The structure of debt money is now embedded. That means future fixes must recognize the debt nature of money, not ignore it. Now let's look at the present. Globally, debt has ballooned. Households, corporations, sovereigns, trillions. The money supply is less about gold, more about credit. Central banks, when they expand balance sheets, create money by buying debt. The system revolves around borrowed obligation. Studies show that much of money in modern economies is created via bank lending, i.e., debt rather than physical issuance. Modern technology adds another layer. Digital money, central bank, digital currencies, CBD, crypto, all promising money, but their value depends on trust and credit. The repeating patterns, boom, credit expansion, gives bust, debt, defaults. Gives policy response more credit, gives consolidation, greater debt. This cycle mirrors past eras when gold standards broke. As one paper titled The Illusion of the Perpetual Money Machine notes, this shift began in the early 1980s with consumption funded by debt, not savings. Another striking example, the dollar. S status as global reserve currency is tied to the ability to issue debt and consume imports, not to gold. The twist, if money is an illusion and debt is the new gold, then simply holding what we once thought was safe, money may be holding thin air. And those with the highest debt claims might now be the true gold holders of obligations others owe. The stage is set for tomorrow's shock. What happens when the promise fails? When debts cannot be repaid? The parallels of history warn us. The architecture built on debt is fragile, yet few recognize it. Money is no longer primarily a tangible commodity or metal. It has become a promise, a claim on future value, and thus highly dependent on debt. Debt has become the new gold, the key store of value and the foundation of modern money. But unlike gold, it is invisible, opaque, and carries risk. Attempts to return to real money or to simply regulate debt will fail unless they recognize the fundamental shift in the architecture, from value based on metal to value based on obligations. In short, if money is an illusion backed by debt, then stability depends on the ability to service obligations, not just on reserves of gold. Here's the warning. If money is an illusion backed by debt, then the next major financial shock may not come from inflation of commodities or gold, but from the failure of debt itself. If debts cannot be repaid, if trust erodes, the illusion collapses, and then the money you have may turn out to be nothing more than numbers on a screen. The open question: when debt becomes the new gold, who holds the true wealth? And what happens when that wealth is suddenly revealed to be a phantom promise? Are we entering a new era where wealth is defined by dead claims, not metal? Think about that. If this video changed how you see money, if you now realize that money is less about gold and more about debt, then don't let it stop here. Subscribe for more deep dives into how money, power, and control shape our world. Like this video, if you believe understanding money means understanding who controls it,